What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, a podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Ryan Pulis here with another episode of the CPA Zone. This episode is brought to you by the Pulis Group, a tax and accounting firm specializing in tax planning and advisory services for small business owners and real estate investors. Today, we're going to discuss the cash flow statement. The cash flow statement is the third of three main financial statements. In the last two episodes, we discussed the income statement and the balance sheet. The cash flow statement is the third of the three core financial statements that helps tie everything together. So the cash flow statement, or sometimes called the statement of cash flows, shows how much cash is flowing into and out of your business. When you receive or spend cash, it doesn't always hit the income statement. Sometimes the cash going in or out of the company is recorded on the balance sheet. Sometimes it's split. Neither the income statement or balance sheet gives us a clear picture of where the cash ends up. It can be reflected on either report. This is where the cash flow statement comes in. It's a report of all the cash coming into or leaving your bank account, regardless whether the cash hits the income statement or balance sheet. So the cash flow statement provides a reconciliation of sorts between the balance sheet and income statement to show where all the cash is going that the company's generated from its various activities in a given period. The cash flow statement should be considered along with the balance sheet and income statement to get a true financial understanding of the company. Remember, the balance sheet shows your company's financial position on a specific date, and the income statement shows your profitability over a period of time. The cash flow statement shows how the cash was used by the company during the reporting period. So there's three main sections to the cash flow statement. We have cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. So the operating section represents incoming and outgoing cash from normal business activity or operations. All of your normal operating cash is reflected here. If you sell widgets, this is where the income and expense from selling widgets goes. All of your normal operating expenses are reflected here: rent, payroll, benefits, all of your office expense, and general and administrative expenses. These are all being picked up in the operating section. In fact, generally your operating section of the statement of cash flow starts with your net income and then adjusts for changes in current assets and current liabilities. This depends on whether or not you use the indirect or direct method, which we'll talk about here in a moment. But all of that typical income statement activities picked up in the operating section. The investing section shows the incoming and outgoing cash related to investments your business makes. This could be investments in equipment or long-term assets, or even investments in other businesses. So changes to non-current assets are what we'll see in the investing section. The financing section shows the incoming and outgoing cash activity related to financing your business. This can be loans, owner contributions, or owner distributions. So this section deals with non-current liabilities and owner's equity. So current liabilities and current assets, changes in those two categories are reflected in the operating section. Changes to non-current assets are reflected in the investing section. And changes to non-current liabilities and owner's equity are reflected in the financing section of the statement of cash flows. So following these three main areas, below we'll see summary lines. So the summary lines show the net increase or decrease in cash for the period, along with beginning and ending cash balances, which will come from the balance sheet. So the cash flow statement generally is reported on the indirect method. I brought this up just a minute ago, so you can report on the indirect or the direct method. The main difference between the direct and indirect method is reflected in the operating activities section. Using the direct method, you use actual cash inflows and outflows in the company's operations rather than modifying from accrual accounting to cash basis. So the direct method presents specific cash flows associated with items that affect that cash flow. Some example lines you might see on a direct method are cash collected from customers, or interest and dividends received, cash paid to employees, cash paid to suppliers. With the indirect method, which is far more common, you start with net income and add back non-cash expenses such as depreciation and amortization, and you adjust for changes in current assets and current liabilities. Under both methods, direct and indirect, the financing and investing activity sections remain the same. So the only difference is in the operating section. Most companies use the indirect method because it reconciles the income statement to cash. Now let's take a look at a few financial ratios and metrics that use the cash flow statement. The first we'll talk about is the operating cash flow ratio, which is a measure of a company's ability to cover its current liabilities by using its cash flows from operating activities. It's calculated by taking cash flow from operations divided by current liabilities. Remember, current liabilities comes from the balance sheet, so we need both financial statements to calculate this ratio. Next, we have the debt to cash flow ratio, which is calculated by dividing total debt or total liabilities divided by total cash flows. This total debt will come from the balance sheet or total liabilities. This ratio measures a company's ability to cover its own debt from cash flows. It tells us about how many years it would take a company to pay off its total debt at the current cash flow level. The third metric we'll mention today is free cash flow. This is calculated by taking operating cash flow minus capital expenditures, which are purchases of fixed assets. This calculation provides the amount by which a business's operating cash flow exceeds its working capital needs and expenditures on fixed assets. So to recap, the cash flow statement provides a clear cash picture for your business. It's used together with the income statement and balance sheet and reconciles the changes in cash. The three main sections of the cash flow statement are operating, investing, and financing activities. The cash flow statement shows how well a company manages its cash position. It complements the income statement and balance sheet to provide an overall financial picture of the company. So that about does it for our discussion of the cash flow statement today. I hope this was helpful and have a great day. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.